Listen to this number carefully. Right now, there are open delivery requests for over 400 million ounces of silver sitting on COMEX. The amount they actually have available to deliver? 103 million. March 3rd. That's the date you need to circle. First position day for March contracts. Less than a month away as I'm recording this. And every single trading day, COMEX is losing roughly 800,000 ounces of registered silver from their vaults. Do that math with me. Between now and March 3rd, at current drain rates, another 20 million ounces walk out the door. That leaves them with about 83 million to cover 400 million in claims. Whether you own precious metals, invest in tech, or just care about understanding where financial stress points are building, what happens in the next 4 weeks will likely define metals pricing for the next decade. And since you literally cannot build AI infrastructure without silver, this affects every market you're in. What I'm about to show you isn't theory. It's not speculation. It's arithmetic using publicly available data from COMEX's own reporting. And if you understand it now, you'll be positioned ahead of 99% of investors who are going to wake up in April asking what just happened. Let me start by explaining what COMEX actually does because most people don't understand this structure. COMEX is the commodity exchange, part of the CME group. It's the official price-setting mechanism for precious metals in the United States, and by extension, much of the world. Here's where it gets critical. COMEX is fundamentally a paper market. The vast majority of participants never touch physical metal. They're trading contracts, essentially promises, that settle in cash, not silver. Think of it like a restaurant where 95% of customers are trading pictures of meals with each other, but never actually eating. That's COMEX. Now, COMEX holds silver in 2 categories, and this distinction is absolutely essential. Registered silver means it's available for delivery. It can leave the vault. This is the metal that COMEX will actually hand over when someone says, "Give me my silver." Eligible silver is metal sitting in COMEX vaults but owned by someone else. It's not available for delivery unless the owner chooses to convert it. When COMEX reports total inventory, they love combining both numbers. It makes the vault look fuller than it actually is, so they'll say we have 400 million ounces total, when only 103 million is actually theirs to deliver. As of right now, February 2025, COMEX has approximately 103 million ounces of registered silver. That's the number that matters. Everything else is noise. Here's where this gets urgent. Registered silver inventory has dropped 70% since 2020, not total silver. Registered. The stuff they can actually deliver. In 2020, they had over 300 million ounces registered. Today, 103 million. And it's draining at roughly 800,000 ounces per day. If you're paying attention, you're already asking the question, how long can this possibly continue? Let me give you a framework for understanding what's happening and what comes next. I call it the Vault Pressure Position Framework, or VPP for short. First, we verify what's actually in the vault. Then we understand the pressure building against it. Then we position accordingly. Vault. We've established the registered amount is 103 million ounces. But that's not sitting in one place. COMEX vaults are spread across multiple facilities managed by different banks and depositories. The number changes every day. In January 2026 alone, almost 50 million ounces left COMEX vaults. Why is that insane? Because in all of 2024, only 6.8 million ounces left for the entire year. We're seeing a 7x increase in physical deliveries. The official explanation? Normal market activity. Right. 7 times more deliveries is normal. Just like your credit card bill being 7 times higher than usual is normal spending. But dig deeper. This isn't just COMEX. Shanghai silver inventories are at their lowest levels since 2016. London Metal Exchange, where one of my mentors was a market maker, is at historic lows. It's musical chairs and the music is getting very quiet. China has classified silver as a strategic material and put export controls on it. The US has done the same. We're not talking about conspiracy theories. We're talking about official government policy. Now, here's a number most people never hear about, but it's the single most important signal of actual availability: the silver lease rate. A lease rate is what it costs to borrow physical silver. Why would you borrow silver? To short it. If you want to bet against silver, you need to borrow actual metal to sell. Normally, the lease rate is less than half a percentage point. Plenty of silver available, low cost to borrow. Right now, it's 8%. When lease rates spike, it means physical silver is hard to find. People are willing to pay 16 times the normal rate to borrow it. That doesn't happen when vaults are full. It happens when vaults are empty and people are scrambling. But COMEX says everything's fine. I'm sure they have a perfectly reasonable explanation for why these are just normal market dynamics. March is a major delivery month for silver on COMEX. That means contract holders who own paper silver can demand physical delivery. The numbers are staggering. There are open interest contracts representing roughly 400 million ounces. Available registered silver, 103 million. Think about this scenario. If just 20% of contract holders say, I want physical silver, not cash, you're looking at 80 million ounces walking out. That would drop registered inventory to about 20 million ounces. If 30% want delivery, the vaults are functionally empty. March 3rd is the first position day. The day traders must declare whether they're taking physical delivery or rolling contracts forward. Between now and then, at current drain rates, another 20 million ounces will likely leave. That puts available inventory around 83 million before we even know how many contracts are standing for delivery. Here's another data point that should alarm you. In February 2025, the delivery rate is running at 96%. That means 96% of people who can take delivery are taking delivery. Over 18 million ounces delivered so far this month. This isn't a bunch of gold bugs hoarding metal. These are traders and hedge funds. And what they're seeing is simple arbitrage. Buy paper silver at suppressed paper prices, convert to physical, and either store it or sell it where physical premiums exist. When I call silver dealers right now, they tell me, sure, we can get you silver, delivery in June or July. June. For a commodity that's supposedly abundant, but if you have enough capital in a COMEX account, you can buy futures and convert to physical at today's price. Why would anyone do that? Profit. But also, and this is speculation on my part, I think industrial users are doing this. If you're building massive AI infrastructure, you need silver. Lots of it. Miners say, we can deliver in a year. Dealers say, 6 months at a premium. COMEX says, here's today's price, delivery in weeks. Which would you choose? COMEX has several options if they can't meet physical delivery demands. Option 1, cash settlement. They can simply pay you dollars instead of silver. It's legal under exchange rules, but it completely destroys their credibility as a price-setting mechanism. They're essentially admitting, we're not really a silver exchange anymore, we're a silver fantasy exchange. Option 2, change the rules. They can raise margin requirements to force contract holders to sell. They've already done this 3 times this year. They can impose position limits, they can make delivery harder. They did exactly this in 1980 and in 2011. They've also just introduced a new futures contract with no right to underlying silver. It's purely cash settled. So COMEX could become a silver-free silver marketplace, which would be odd. Option 3, price divergence. Paper silver and physical silver prices could split dramatically. We're already seeing this. Shanghai physical silver trades at roughly a $35 premium over COMEX paper prices. In a functioning market, arbitrage would close that gap. You'd buy COMEX futures, take delivery, ship to Shanghai, pocket the difference. That's exactly what happened with gold in early 2025. Traders bought London futures, took physical delivery, shipped to the US, and sold at a profit. Now, what does COMEX say about all this? Delivery concerns are theoretical. Translation: we haven't run out yet, so stop asking uncomfortable questions. What I've learned from mentors who work these exchanges is that markets repeat. Not exactly, but the patterns rhyme. Let me show you the playbook. This has happened before. 980, Silver Thursday. The Hunt brothers accumulated a massive silver position. Silver ran toward $50. What did the exchange do? They implemented Silver Rule 7. It limited trading to liquidation only. You could sell, you could not buy. Imagine your brokerage telling you, you can sell your stocks, but you cannot buy. That's exactly what Robinhood did with GameStop, by the way. Result? Silver crashed from $50 to $10, an 80% decline. The Hunt brothers were wiped out. The exchange said they were maintaining orderly markets. 2011, the margin massacre. Silver ripped higher after the financial crisis. People lost faith in banks. Can't imagine why. Silver hit $49, nearly matching the Hunt brothers' high. What happened? CME raised margin requirements 5 times in 2 weeks. Each hike forced leveraged traders to sell. Cascade of selling. Silver crashed nearly 50%. The pattern? Silver threatens to break out. Exchange changes rules. Price crashes. We saw this in December 2024. We're seeing it again now. Same playbook, same players, same outcome. If you're cynical, you might notice the exchanges only manage risk when prices go up. You never see them raising margins when silver is crashing. Funny coincidence. But here's what's critically different in 2026. In 1980, COMEX had plenty of silver. In 2011, vaults were full. They could change rules, raise margins, and kill the rally because they had physical inventory to back it up. In 2026, the vaults are nearly empty. They can change rules, yes. They can raise margins, yes. But they cannot create silver that doesn't exist. I'd say we're in the final phase of a pattern we've seen many times, except this time, the vaults are empty. Now let's talk about the third part of the VPP framework. Position. This is not financial advice. Silver has been in supply deficit for 5 consecutive years, roughly 200 million ounces per year. Since 2021, we're short about 1 billion ounces cumulatively. Why? Demand. Solar panels use about 20 grams of silver per panel. Solar installation is growing exponentially. Electric vehicles need 5 to 10 times more silver than gas cars. AI infrastructure. You literally cannot spell AI without silver. Electronics, semiconductors, data centers. Total industrial demand, approximately 700 million ounces per year, and growing fast. So why don't miners just produce more? Here's the problem. 80% of silver is a byproduct of mining copper, lead, and zinc. Only about 20% comes from primary silver mines. You can't just mine more silver. Even if silver prices double, it takes years to bring new mines online. And the copper, lead, and zinc mines, where most silver comes from, aren't going to ramp production unless there's demand for those metals. Silver supply is structurally constrained. Let's be clear about the difference. Paper silver. ETFs like SLV, futures contracts, mining stocks. Advantages? Liquid. Easy to trade. No storage costs, no insurance, no security risk. Disadvantages? Counterparty risk. You might not get silver, you might get cash. And if paper and physical prices diverge, your ETF might not track actual metal prices. Physical silver, coins, bars. Advantages? No counterparty risk. It's yours. You own it. Disadvantages? Storage, security, premiums when you buy. Less liquid, harder to sell than pressing a button on an ETF. The official position of the financial industry is that paper and physical silver are equivalent, which is true, until it isn't. When Shanghai is paying a $35 premium for physical over paper, they're not equivalent anymore. When I can't get physical delivery for 6 months, they're not equivalent. I'm not saying silver goes up tomorrow. They could change the rules. They've done it before. There could be short-term crashes, margin hikes, trading restrictions. The risk is that short-term traders get burned. We've seen it many times, but the opportunity is based on this. The vaults are nearly empty. The supply deficit isn't going away. Industrial demand is accelerating. Even if they paper over this crisis in the next month or two, the fundamental problem remains. There are analysts with $300 price targets. Others say $50 is the new floor. I'm not going to give you a number, that's just clickbait. Nobody knows. But the supply-demand fundamentals are the tightest they've been in decades, possibly ever. What you actually do. Step 1. Watch March 3rd. First position day for March contracts. Watch how many contracts stand for delivery. If it's above 75 million ounces, things get very interesting very fast. COMEX would be out of silver almost immediately. Step 2. Track registered inventory, daily or weekly. If it drops below 80 million ounces before first notice day, the math becomes impossible. Step 3. Watch the lease rate. We're at 8% now. If that spikes higher, it's the market screaming that physical silver is scarce. It's the same as a borrow fee on heavily shorted stocks. When it goes parabolic, you're at a point of no return. Silver is highly speculative. It shouldn't be, but it is, because the powers that be have been speculating with it profitably for decades. Gold, in my view, is the less speculative long-term hold. Gold might do this. Steady upward line. Silver will do this. Volatile zigzag upward. Can you live with that? Is your stomach built for it? If the last crash made you unable to sleep, if you went home and drank a bottle of whiskey, you have too much silver. Simple. Risk tolerance comes down to position sizing. If you have 10% of your portfolio in silver and it crashes 30%, you've lost 3% of your total wealth. Manageable. If you have 20% in silver and it crashes 30%, you've lost 6%. That starts to hurt.